Let's shift gears to a kind of an update, but Brennan, you're gonna get back to a viewer that talked about Fluence Energy. You talked about them in your stock our take, or was it a dog? Sorry, it was a dog earlier this year.
Yes, exactly. It was a dog
Nice photo.
that I covered it. Yes, thank you. But yeah, and this is a company, I wrote a monitor report on it. We did a dog on it after, the company came reduced guidance. But yeah, so to go over it, it can kind of be like a your stock, our take, as well as a star. So it is Fluence Energy, a stock which, again, I covered as a dog back in February of 2025 when it was down 50% in one day after the company had lowered its fiscal year 2025 guidance. And recently, we had an individual comment on the YouTube segment indicating that the business has recovered from its lows, now up 30% in the past 5 trading days and up over 400% in the past 6 months. Again, keep in mind these are from depressed levels after the stock dropped. But let's dig into the stock a little here and see if the recovery is justified and what is driving it. So Fluence Energy, FLNC on the NASDAQ, currently trading at a price of about $19.36, about a $2.5 billion market cap. They do not pay a dividend, and they deliver intelligent energy storage and optimization software for renewables and storage. The company's solutions and operational services are helping to create a more resilient grid and helping unlock the full potential of renewable portfolios. And Fluence Energy was formed in 2017 as a joint venture between two massive global energy companies, power producer AES on the New York Stock Exchange, and German energy equipment giant Siemens AG, SIEGY on the OTC. And here is just a visual representation of when we looked at the stock. I initially wrote a monitor report in July of 2023 for clients, indicating to clients that it's a name to place on their watch list as we track the company's progress toward profitability. And then I reviewed the company again after it was cut in half following the company's downward revision to fiscal year 2025 guidance in February of this year. And we have now seen the stock have a bit of a dead cat bounce or recovery from its lows. So looking at the Q3 2025 results, which were reported in August and are for the period ended June 30th, 2025, revenue was up about 25% year over year, primarily due to revenue timing weighted to the second half of 2025 compared to the revenue distribution seen in full year 2024. So, it is a little bit contract driven. Can see it be a little lumpy. As well, the company signed approximately $509 million in Q3, bringing the backlog, or how I have it here, consolidated performance obligations. So bringing the backlog as at June 30th, 2025 to $4.9 billion, which is up about 9% year over year. So that backlog does remain healthy. So looking at the top line here, we are seeing a sequential improvement compared to the beginning of fiscal year 2025, and backlog remains strong. As well, just looking over at the balance sheet here, it remains healthy. They did do a convertible debenture offering over the last year, or maybe, over the last year, essentially. So the balance sheet has taken on a bit more debt since we looked at it last, but it still remains in a net cash position with 53 cents per share. And I also believe this is just kind of another note that the business executed a new supply chain financing facility in August. So that was subsequent to the quarter end here. So we may see the company dip into a net debt position in the coming quarters if they do not improve their cash flow and they start to utilize that facility. Looking at the profitability, adjusted EBITDA was $27.4 million, up 76% year over year. Net income attributable to Fluence was $6.2 million or 5 cents per share, up substantially from $800,000 or 1 cent per share in Q3 of 2024. Cash flow was also significantly negative in the quarter, as you can see there on the yellow line. So, essentially, we can see here that sequentially, margins have been improving to some degree and are getting back to in line to where they were in fiscal year 2024. But the beginning of the year was a little rough. Now, As I went over in my dog segment on the company back in February of 2025, the company then lowered its total revenue guidance range to 3.4 billion from its initial guidance of 3.6 to 4.4 billion, which was about a midpoint of 4 billion. And management said that the 600 million reduction in revenue from the previous midpoint was primarily due to the timing of certain contracts in Australia that the company now expects to sign later in the year. And they also lowered its fiscal year 2025 adjusted EBITDA guidance range to a midpoint of 85 million from its prior guidance of 160 to 200 million, which was a midpoint of 180 million. So we also saw, a significant decline there. Now, looking at the most recent update to guidance, management now expects revenue to be in the range of 2.6 to 2.8 billion, which is flat year over year, as they did about 2.7 billion in fiscal year 2024. And adjusted EBITDA is expected to be in the range now of break even to 20 million for the year, which is down significantly from the 78 million achieved in 2024 and down substantially from their, initial guidance at the beginning of the year when they were looking at 160 to 200 million. Then they revised it to 85 million at a midpoint. Now, we're looking at basically break even to 20 million for the year. Management also said on the conference call, despite the macro headwinds that have occurred this year, such as tariffs and legislative uncertainty, we have continued to take necessary steps to manage the business for profitability and cash flow, and this is reflected in their results. Now, quickly looking at the valuations, they all remain very expensive. Cash flow and net income remain negative over the last 12 months. So those ratios, really meaningless when they're negative there. And looking forward, the business trades at about 243 times enterprise value to EBITDA. So very, very pricey here after the recent move up in the share price. Fluence has remained on our monitor list as it is an intriguing business in the battery and energy optimization space with a strong balance sheet and growing backlog. The stock has performed well as of recent due to the better sequential results from the beginning of the year. Fiscal year 2025 guidance and the fiscal year 2025 results are still expected to be weak, and management will provide updated guidance when they release their Q4 2025 in November. So we can look forward to that. And while the results have been improving to some degree, the valuations remain extremely high. I would continue to monitor the business at this time. Again, I like the space that it operates in, but still very, very early and very, very expensive. And we do not. Here's the disclosure.
Yeah. It's a good summary, really good growth, but historically, but high valuations.
Yep.
You're not building any margin of safety in with an investment in this company now.
Exactly.
Yeah, you're speculating on future revenue growth, continuing to drive higher and then better margins over time so you can have higher cash flow. We just prefer to there are businesses that grow at a similar rate that you can find at a more reasonable price. And that's what we're looking for. I mean, we talked about one earlier this year, right? Like we looked at those two businesses. I mean, they're in no way comparable in any way, but we looked at them at the start of this year. Right? One was for a podcast, one was for an actual investment, but we run the numbers on them. One is trading at a reasonable multiple, has a good growth path ahead of it, better debt situation likely, and one is a recommendation, one is something we're just monitoring, and you can see the difference in the returns in those companies over the course of this year.
And here's the thing too is if somebody wanted, like I'm super interested in like this energy battery storage space. We have another recommendation that's currently a buy right now that is focused in they've got a few very interesting projects for battery storage. So this is an interesting business.
Yeah, it's paying a 6% yield and has likely trading at 6 times cash flow, has growth going forward likely built in this year.
There's a case
could increase its dividend.
Exactly. There's a case to be made for investment where, like Ryan said, this is just with Fluence right now. It's just, maybe if you're looking 20 years out, or maybe not that long, but 10 years out, and management can
And the
execute
growth
and
has
grow
even
cash flow.
slowed in the last couple of years,
It
right?
has.
I mean, if you go back to 2019, 2020, 2021, 2022, and it started to slow into 2023 and grew again in 2024, but now it's come off the trailing 12 months. So,
So there's
you
names.
need growth to continue. You need margins to continue to go higher. And there's been a slowdown in growth, and you're trading at premium valuations.
I was going to say, I think the valuation has been really driven by, you have really two factors. You have AES being potentially acquired by BlackRock. So the majority, one of the founders of Fluence is likely getting taken over by BlackRock. At least it's could happen. It's very likely. Whether it closes or not, who knows? And then secondly, just the AI side of it is there's more AI interest in these battery storage solutions. So is that going to amount to something or not? Like Brennan was saying, it's 5 years down the line probably to actually be commercially viable en masse. But you are starting to see some of those factors from the theme of the last 2 years coming into Fluence more and more. So is it just purely a stock price change? Like, that's what I'm seeing personally. I don't know if you had any.
I agree. Like, even in our chat sessions, with clients, we get a lot of, how can I partake in this theme? And, even to the point of bringing forward, nat gas companies. Hey, is this company going to benefit from AI? Essentially, and like the energy demand from AI. So, I can definitely see that theme is so popular right now. And certainly, I would agree, bidding up the valuation and price on Fluence here.
So the right answer in these cases is his companies that we bought a couple of years ago, for example, that were already positioned for not necessarily AI, but now they're benefiting from it, but they're highly profitable, have the good solid balance sheets. Now you're starting to be behind the 8 ball. People are searching, people are reaching. This is when you can get into trouble. And, we just, 18 months ago, 16 months ago, we were able to buy a company, Argan Inc., right? That it then traded with a massive percent of its market cap in cash. And they're helping power some of the data centers, right? And it's like the stock was $48 then, it's $300 today. That was your growth situation. That is your portfolio changing situation. Now you're looking at companies, that are trading at valuations where everything has to go perfectly going forward. There'll probably be another opportunity in the next year to buy companies at a more reasonable price that have participation, that have exposure to that segment. But, we're not seeing much with value that you can buy right now to give you exposure. And there's a lot of companies out there that are not going to do well. Not that they're terrible businesses. There are some terrible businesses that are not going to do well, but there are companies out there that maybe are a decent business, but are trading like Fluence, may be a decent business, but it's trading at such a premium valuation. Everything has to go right. And you don't want 20 stocks in your portfolio where everything has to go right for this company to just justify its current valuations.